Hello, everyone, and welcome. I'm Misha Davis, CEO of Arizona Foundation for Women. And like the rest of the world, everything we're doing now is virtual. So we're excited to be partnering with Doretta Thomas, who started Ladies Leaving Legacies, and you'll hear from her in a moment. But before we get started, just a couple of things that will help you through this webinar is you can do anything you want on the screen. The great thing, it's very interactive. So if you want to go to the slides, you can click on that. You can make the page bigger by just clicking and dragging in like one of the corners, or you can just click back on the presenters that are speaking. So, or if you're tired of looking at my face, you can go to the slides. But so just know that you can move your screen about as you need to for better visibility, or just trying to have other things on your screen. So with that, just one quick thing. I'm so excited to announce that this year we're celebrating our 25th anniversary as a foundation helping women in our state. And we're looking forward to another 25 years and beyond. And really just our number one priority is to help women in our state have health, be safe, healthy, and economic empowerment. So our mission basically is advancing the status of Arizona's women through research, through projects, through our advocacy work, and through our philanthropy and grant making to local grassroots nonprofits, really with missions focused around women. And sometimes we will grant out for young girls as well. So the whole goal of that is to ensure that they're safe, healthy, and economically empowered. And we do that through a couple of ways. As I said, we do a major research project every 3 to 4 years, and please watch for our research release that's coming out in the beginning of 2021. It's our 2020 Research Status of Women in Arizona report, and we are excited about that. It's a lot of information that will help us move forward in addressing the real key alarming issues affecting women in our state. The other thing, as I mentioned, is we advocate for women. So we basically, at the capital level, at the state level, city, working with government and city budgets and helping keep things that are going to protect women and help that rather than be a barrier to women. And lastly is, like I said, we do philanthropy, working with individuals who want to leave a legacy, something you might hear about through Doretta today, and also grant making to local nonprofits. So with that, let me have the pleasure of introducing someone I like to now call my friend. And she is a volunteer on our professional advisory committee group made up of wealth advisors, insurance agents, wealth attorneys, estate planners, you name it, anyone in that realm, and insurance. And so Doretta is the managing representative with Transamerica. And she's been doing this work for a long time and had a personal journey that really spiked her call to do this work. She found herself in a situation that she wants to help prepare other women for, hence why she started Ladies Leaving Legacies, and helping you understand the importance of giving back, up your family in the time of those days none of us want to talk about, but when we're no longer here, and making sure that things are set so that they don't have that burden put on them. One thing that's great about her is she's a strong woman, cancer survivor, and mother of 5 sons, and she has 5 grandchildren. But what's even great through all the tragedies she's experienced in her life, she wrote 2 books. One is Dying is Not an Option, which you will hear from her hopefully, and her publisher has graciously decided that any proceeds from the book from this webinar, we will see a slight donation for that. And she also wrote Sticks and Stones, Overcoming Verbal and Emotional Abuse, which was published in 2008. So she had a little break in there, but she came back full force and put out another book this year. So we're all excited to share that with you. So with no further ado, I'd like to introduce my friend and long new family member of Arizona Foundation for Women, Ms. Doretta Thomas.
Well, thank you. Thank you so very much, Misha. Those were some kind words, and I appreciate those words. And yes, I want to start by saying that I started with Arizona Foundation for Women a few years ago, and it was an organization that I knew I had to be a part of. They really go out in the community, the state of Arizona, helping women get back on their feet, teaching them how to get jobs. So it was something that was near to me, to my heart. So I really enjoy being a part of the AFW family. And so, again, just happy to be here. September is Life Insurance Awareness Month in the insurance world. You know, it seems like every month we've got something. We've got breast cancer month, that's next month. We've got prostate, we got, you know, all different types, but we have designated September for Life Insurance Awareness Month. So I like to come on, just talk to you, share some information with you in terms of what you need to do, especially as women. Number one, we live longer usually than our counterparts. And so sometimes we find ourselves not properly prepared because some of us have not worked as long as our husbands or significant others. So sometimes we are behind the 8 ball. So I just want to share some things with you. And first, I'd like to just kind of share with you my story. Like Misha said, in 2018, in January of 2018, I found out that I had breast cancer. The next day, less than 24 hours, my children's father was declared dead. So within 24 hours, my children's and myself, our lives were just turned upside down. With me being diagnosed with breast cancer and them losing their dad. So of course, the first thing they're thinking is, okay, we can't lose mom either, because then, you know, we don't have mom or dad. So they were really, frightened and terrified, as they should be. And so my goal throughout this whole process was to make sure my children and my grandchildren know that I'm going to be here. I'm not going anywhere. I can't go anywhere. And so hence that's where the name of the book, Dying is Not an Option, came from. I was in the room with 30 doctors, and they were all going over my case, kind of giving their opinions of how we should tackle my cancer. And so at the end, they just asked, Ms. Thomas, do you have any questions? And I told them, nope, I don't have any questions, but I do have a statement. And dying is just not an option for me. My kids just lost their dad. They cannot lose their mom. So whatever we have to do, we have to do. So that's how dying is not an option came about, because that's what I told them. And I meant that. I stood on that. So again, I had critical insurance policies, and then obviously we had a life insurance policies for their dad. So I share even more so why it's important, because after going through that, I learned that with the critical illness is that my checks, I had 2 checks that were delivered within 14 days. And so that was to be used however I needed. So co-pays, deductibles, bills are still coming in. So nothing stopped. Nothing had to stop. I was able to hire a full-time caregiver to just kind of take care of me, because I didn't want my children to have to worry and try to come in and do things, especially as boys. So I did have a friend of mine flew her in from Hawaii, and she took care of me, and she took great care of me. But those are the things that I may not have been able to afford had I not had my critical illness policies. And so that's why it's so important to make sure you have the things that you need set up properly. I know a lot of times we think, oh, I've got money in the bank, but I will tell you this, it only takes one catastrophic illness, and you can wipe out pretty much your savings if you're not over in the $3-4 million range. So even I've seen people $1 million, $2 million, and by the time they've exhausted everything, 5-7 years after, they have nothing. So we do need these policies to extend so that we don't have to take money out of our own savings account or 401ks, because that's another way we as women who are living longer, we need to have, if you have a 401k, you want that for your retirement, not to live off of due to something catastrophic happening. So again, that's my story in terms of why I am even more passionate, because like I said, the critical illness policies came in handy along with the life insurance policies. The life insurance policies ensured that my twins, one at ASU and one at GCU, would be able to finish and walk out without any loans. And so that's what they did. So I can't say enough about life insurance. I know people can, talk about, like I said, 401ks, they can talk about stocks and bonds, and those are good. But I will say life insurance is usually 100% tax-free, and all those other entities, you've got to pay Uncle Sam, because he's tired of you sitting on the money without giving him some. So with further ado, I'm going to go into our slideshow, and hopefully I will get this right here. So again, welcome to Ladies Leaving Legacies. Transamerica, we've been in business over 100 years. I write for Transamerica, but we also have another maybe 200 companies that I can write from if it does not, if Transamerica doesn't have what we're looking for my client. I can't go, elsewhere. So that I like. Okay. And then the pyramid of the financial strategy is such, and I will say, you see the bottom line is life insurance. That's the root. That's your tree trunk. You've got to have life insurance to start. All those other things, the health insurance, the disability, short-term, long-term care, then getting into nursing home and retirement plans, and building your assets. All those are steps above. But we start usually with a life insurance policy, okay? And right now, your income, earning power, and buying power is yours, okay? With women right now, we are leading the way. And I know a lot of us already know that, but we are closing the gap on consumer electronic spending and automobile purchases. We are buying, and it's ironic too, because we're buying big trucks. I've always loved big trucks. So women are buying, they come in and buying the large F-150s and the 250s. And so we're at a different time than our mothers and our grandmothers were at. Okay. So with that being said, we got a high net of wealth owned, controlled by individuals. Okay. And so the higher our net worth, as you see that, is coming up. So we're getting higher paying jobs. As Misha, CEOs, we're getting positions that are bringing us more money than we've ever had. Okay. Single women have accounted for approximately 1 out of 6 home buyers, and that's since the 1990s. So it's definitely just shot up. I have friends who are realtors, and they say right now is really a great time to buy. And again, most of their houses go to either families or single women. So we are definitely, again, leading the way in that sense. Married women are increasingly controlling the household. There used to be a time when the husband took money and he took the money and did whatever he wanted to do with it and gave the wife allowance. I think those days are pretty much over now. Usually the man sees that the woman can navigate through the perils of paying the bills without him. Usually he just want to know the overall, and she gets into the everyday type things. And we're caregivers, but what about our long-term care? Okay, so long-term care is something that they say now, if you live to be 65, you're going to, chances are you're going to be here another 20 years, maybe even more, but definitely another 20 years. Okay. So again, like I said earlier on, women, we are we are here usually longer than our counterparts. The typical caregiver, though, is about 46 years old. So therefore, say if you have a mom now who is 70, 75, you're 45 or 50, you may be taking care of a mom. In some cases, I have people who've been taking care of mom and dad. So it's not uncommon to see kids taking care of mom and dad, both parents. Okay, and it says 1 in 6 provide 40 plus hours per week. So that's a long time. That means, what do you do? Do you stop your job and be a full-time caregiver, or do you make the preparations to have long-term care, and then you can assist and keep working? Okay. 44% levels of physical strain and emotional stress due to caring for a loved one. I remember I had a friend in Memphis who her daughter was a nurse, so she was around elderly and sick all the time. But when she had to take care of her mom and dad, she actually had a nervous breakdown because she could not care for each one. They just drained her. So it's a lot on us. A lot of times it's wear and tear on our bodies, because we're trying to, pick someone up who's larger than us. And I know usually most dads don't want their daughters to see them undressed. So, like I said, if there's any way that we could start the trend where we're talking about long-term care more, that's really what we need to be looking at is long-term care. And there's ways I'm going to talk about, later on, how to put the long-term care piece in your life insurance policy, because it's not something that I may need. It's going to be when I need it. Okay. So more than 60% do have a career, make sacrifices at the home to accommodate the caregiving. And again, usually it's the female, usually it's the wife. Okay. And so what does that mean is now we've kind of stopped some of our earning power. Okay, so the need for long-term care, because again, like I said, women outlive men by about 5 years. I say even longer than that. And if you reach 65, like I said, you can expect to live an average of 20 plus years. And more than 2/3 of Americans age 85 and older are women. So I know that's been very true in my family. My mother just passed away in June. She was 86. And my grandmother passed away about 5 years ago, and she was 106. So definitely we are living longer. And so I believe my mother had to take care of my grandmother. So I think that was kind of some of her downfall in terms of her health as well. So you see why it's so important to have long-term care, because then we can just kind of navigate the care and not be that everyday ongoing partner. Budgeting for long-term care, homemaker service, about 45, home health aid. You see these staggering numbers, and they've gone up. Let me tell you, this is a slide from 2016. And if I update that, we're probably at about at least about 8,000 more on each one of these. So again, budgeting for long-term care. If you have your 401k, if you have a retirement, that shouldn't be counted as your long-term care, because again, that's for your living, that's for your retirement. In the event of something happening where you need assistance and care, that is where your long-term care or your short-term care, you could pull from that and not interrupting any of your monies. Okay, you see a private room at a nursing home is it's about 100,000 now, but back in 2016 it was 93,000. So definitely a long-term care policy is essential. And retirement, yes, I'm sure you want to retire comfortably. Most of us do. And what do you expect to be your primary source of income? Most women said their 401k, their accounts that were held through their jobs. Okay, so again, if we haven't worked a lot, because we have been the wife and the mom, stay-at-home mom for some period of time, then we don't have a lot of that built up. So again, we've got to look at other ways where we can supplement our retirement. Okay, so insurance policies is definitely one way where you can definitely make a difference in that. You can make that up. Okay, so the you see those staggering numbers there, just in terms of 43% say that's where they're going to get their source is from their 401k. And unfortunately, sometimes the 401k is not that much. Where I just did a 3-day class, and they were saying people about 65, 68, roughly have about 100,000. And that's not going to last too long. That's not going to take them too far. So we've got to get some other things in place here. Okay. And the age that women expect to retire, I think we were all looking at probably 65, 66 to 69. And so a lot of times we're having to work longer. We didn't plan on working that long, but things happen. Again, the husband passed away, you don't have that second income, because if you are married, you get to have one Social Security, and usually you take his, but yours go away. I don't care if that's even a $500 a month Social Security, that's still $500 a month that you no longer have. So again, a lot of times that pushes us back out into the workforce. When we say we're going to retire, you see them doing little part-time jobs, or either sometimes they have to stay in their jobs even longer. So again, just being prepared of just how much we need our retirement base, and then sold separately our insurance products as well. And when we talk about the confidence in retiring comfortably, most of them was not at all confident. And so I talk to people all the time, and they have that same thing. Doretta, I'm afraid I'm going to outlive my money. That's the number one question, Doretta. I'm going to outlive my money, and I don't know what to do. So again, just trying to put some things in place. And now this is where I come in terms of the leaving the legacy part, with ladies leaving legacies. This is why I started this, because it was so important to get the word out to women that you can leave a legacy, and you don't have had to have worked at some 6-figure job all your life. You can still leave a rich legacy for your family. Okay, and for others. You can also donate money. We at AFW, we look for, contributors all the time, donors all the time. So someone passes away, you can definitely leave some to AFW and your churches and whatever else is near to you. But how long would it take for a family to feel the impact of a death, the financial impact? Well, you see here, pretty quickly. So again, that's why as women, we need to be more prepared, because we see on the news all the time, a lot of these men in their 50s, I don't know, it's like the 50, 60 age is really leaving us quickly. So again, that means they have probably children at home that haven't finished college, are about to go in college, and their dreams may be thwarted because now, they don't have that second income. They don't have that extra money that was coming in from the other spouse. So, and just kind of knowing what to plan for, is not so much will I die, but it's will I get sick? Will I live too long? Will I leave a tax burden? And then will I die too soon? So a lot of times we've got other things that are more pressing in terms of dying. It's just like, what if I get this bad report? How long will I live? How long will I have to live sick? Will I live too long sick? So again, we've got a lot more on us nowadays than again, our mothers and grandparents had. And just knowing how to plan for all of life's challenges. We can't plan for, we don't know, we don't have a crystal ball, but we can definitely have some things in place, okay? We can definitely have some things in place. And 5 reasons that I like the Indexed Universal Life policy with the living benefits. Number 1 is the tax deferred growth. So therefore your money grows tax deferred. And it's called first in, first out. So everything that you've put in when you get ready to take out is tax free, and then you just pay the tax on the gains. But there's no contribution limits like in your the Roth. Those figures have gone up now, but you see that there's no contribution limit and no early withdrawal penalties. So you don't have to wait to 59 and a half and with your Roth, okay? So you do have a little bit more flexibility. And with the IUL policy, you have flexibility in payments as well, okay? And again, better for your heirs, is not subject to any income taxes. Proceed goes straight to the beneficiary. And the IUL, the index, that's what it's called, the Indexed Universal Life. The index part of it means you're going to participate in the upside of the market, but not the downside. So there's a cap where you go down, and there's a cap to how you come up, okay, how far you go up. And again, so that you've got the market protection, which is a great asset to have, because you figure that once you're tied into the market, I mean, you can have great years. I mean, I've sat and folks got 20%, 22%, but then also they can crash 22% too. And depending on how old you are, you may not have time to make that up. Okay, you just don't have time to make that up. I tell people all the time, at my age, if I suffered a loss, I don't have the time to make it up, you know. So again, that's why I believe in the life insurance, and especially if I'm trying to get more from my retirement and again, the critical illness and the long-term care, all those can play into the life insurance policies. So what I'd like to talk about is, I'm going to go with the term first, then I'll break down whole life, and then we'll get back to the universal life. The universal life policies, like I said, is really the more that you're going to be looking for is to help you through your retirement, or if you were to have a catastrophic illness, okay? Your term policy is just what it's called. It's for a term. It can be for 10 years, 15, 20, 25, 30 years, okay, depending how old you are. Okay, the older you get, the shorter the term goes, okay? But I typically sell term policies to young families who are just starting out. They may have a new house, a couple of little babies, so they can get $1 million policy if they're healthy, you know, and height and weight is appropriate. They can get, you know, $1 million policy for, you know, I don't know, 30, 40, 50 bucks, you know. And so they can write that out. That could be a 30-year term, a level term. So it doesn't go up every 5 years. Some terms go up every 5 years. So you may get a term that start out as cheap as 20 bucks. Okay. I have people all the time say, oh, I see the New York Life advertisement, or I see Colonial Penn and all those different things. But the term policies, a lot of times, they're increasing term. Okay, so what that means is every 5 years it goes up. So eventually it tops out to where you may not be able to afford it anymore. Okay, but a level term stays level. So you pay that from day 1 to day 30 if you choose to take a 30-year term policy out. So that's the term policies, and also they're good for if it's say a business, say 2 business owners, one dies, the other person wants to buy the wife out so he can or she can keep the business going. You know, they're good for businesses. Whole life policies are just what they say, their whole life. So they don't go away. They are, we're taking our policies now to age 121 years. So 121 years. So usually that's policy you're gonna take all the way, to the end. Those policies are a little bit more expensive than your term policies. Because why? Because those are policies that you're probably going to use. Okay. So again, the whole life policies, they don't add a lot of cash value. And the difference with the whole life policies is if you pull money from your whole life policy, eventually you may need to pay that back. Unlike the other policy that I'm going to start talking about, the universal life policy. But so with your whole life policies, you have to be careful. You have to be careful of how you take money from those policies, because sometimes you look up and you've kind of eaten up the actual face amount of the policy. So you have to be careful with those. You have to stay on top of that. And I tell people, if you don't have to, just don't borrow it. Just leave your money in there. Okay. And so then you have the universal life policies. Like I said, it just has more of a just a convenience. You have the different ways you can design it. You can have it just with critical illness. You can have it with critical illness and long-term care. It can be used for your retirement. You can pull from your retirement, or it can just build and build and build. So again, it's really what is best for you. But I do see that the universal life policies is definitely a way that women can secure, along with your other things as well, your Social Security, your 401k, whatever. But you can secure just something in another tool in your financial portfolio. And again, usually is tax-free unless you are taking now from the actual interest, what your gains rather. Okay. So again, I do want to share and break down critical illness and long-term care policies as well. Critical illness is sometimes called chronic illness. Okay, so they're one and the same. So that means if you get diagnosed with cancer, like I did, have a heart attack, or have a stroke, okay, usually you can turn those policies on, and you can turn those policies on quickly. Your doctor just writes a form, go through the form, and tell them what day your occurrence happened. And usually those monies come to you very quickly. And again, the critical illness policy is so critical because, again, when I was going through my cancer, I remember the reconstructive surgeon telling me that, there's 10,000 or more than 10,000 women a day getting diagnosed with breast cancer. Just more than 10,000 women a day is getting diagnosed with breast cancer. That's mind blowing. Okay. And then we know that we have more women having heart attacks or strokes, So again, having those policies or having them inside of a life insurance policy is a neat thing to have. It just kind of gives you a little bit of a security, Mine was not in my life insurance policy. Mine was separate. I got mine a long time ago when a lot of the insurance companies were not combining them with life insurance now. But as now, to make it a little bit easier, you can get a life insurance policy with long-term care and critical illness in it all at one. Okay. So long-term care policies is something that you can use if you have, again, say a catastrophic illness or a condition. Say you hit in a car accident, you won't walk again, you can't feed yourself again. Boom, you qualify. Say you have a heart attack, you can no longer work. It has affected, or maybe the stroke affected your speech, or but you can definitely, if you have 2 out of the 6 assisted daily living, then you can qualify for long-term care. Okay, so that would be eating, dressing, transferring, that's getting up and down, toileting, your loss of like banking, things of that nature. So if you have 2 of the 6 ADLs, then you can definitely qualify for to kick on your long-term policy. Say if you have, again, a situation or an illness where now you have to modify the home. I was just talking to a client that they just had to modify the showers in their dad's bathroom. So that's something that could, turn on a long-term care policy. Okay, those things of that nature. So again, and I know a lot of people are worried about COVID, and some of us may not be working as much as we were, but I will tell you, life insurance right now is just so critical, even more so with the COVID. I get on Facebook all the time, and I can't tell you, probably 3 to 5 posts a day is someone saying they've lost a loved one due to COVID. Okay, and so if you don't have it, you probably need to get, even if you start off with a small policy, just get something, because again, you just don't know what may happen. They're even talking about little kids. I know I was reading an article where it said a little 6-year-old got it, and then the next week she had passed away. So again, we need life insurance. We need life insurance. We need that to keep our families going. My one of my goals is to make sure that when I pass away, I've left a legacy for my children and my grandchildren. That's important, to give them that step up. So many times, kids don't have that. And so that's my goal, is to leave a legacy. And one of the ways I'm leaving a legacy is through this particular universal life policy. I have one for myself, and I am leaving that, again, as a legacy with some other things. But definitely, we need life insurance. We need, the critical illness policies, long-term care. We just really need to start looking at those things as females. Now, if you have a job, I tell people, get everything you can that's offered on your job. But just know, usually when you leave that job, you leave your life insurance. Anything that they don't give you an actual policy that you hold in your hand with a policy number on is their policy, not your policy. So when you leave that. Okay. So you want to make sure that you have some things in place. So when you retire and when you get ready to leave, you've kind of taken care of some things, and they're not at a 65 or 70-year age, because that's when it gets astronomical. So that's why I tell people, you start looking at your policies. A good age is 40, 45, to start looking at these particular policies. For the universal life policies, obviously whole life policy is from 15 days to 121 years. So, but each policy kind of does, its own thing. They all kind of work. They all do the same. They pay out, but at different times. So definitely get with someone who knows what they're doing, who can walk you through these policies and see what you've already had. If I sit with somebody and they have everything they need, then I'm going to tell them you've got everything you need. Okay. But you do need to know that right now, my number one concern for women is just the long-term care piece. I can't stress it enough. And the critical illness pieces. After going through what I've gone through, I just know that every woman needs a critical illness and long-term care policy. So again, just start thinking about that. I don't know if we are at the questions yet. If not, I can keep going, because I've got lots to talk about. I can I can go on about what the underwriter looks for. Okay. I am working with a gentleman who happened to have had bypass surgery 8 years ago. He never told me. Now, on our policy, on our applications, it just asks for usually the last 3 to 5 years. Okay. But that's something that I still should have known, because I could have put that in the forward and said, okay, even though he doesn't have it now, he's not taking any medication from it. You know, he had it in the past. So that opened up a whole big can of worms. And because when we take an application on a person, we run what's called the medical data report. And that shows up everything about a person and everything that your doctor has put in there. So, so now we're kind of backtracking, and he's having to go around to his doctors and send in some information saying that he doesn't have any issues. So again, what underwriters look for is medications that you have not put on. Sometimes people think just because I didn't take the medicine, I don't need to put it on there. But whatever your doctor prescribes for you, that's as if you've taken it, okay? And if you take a medication and you take it more than 6 times, you have it refilled more than 6 times in a year, that's called chronic. So if you're taking something, I have a lot of people who are on pain medication, and if they're getting more than 6 refills, they could potentially drop from a preferred to a standard, or a standard to a rating class, because now the company sees that you've got a chronic condition, okay? If I see people that have more than 2, say, blood pressure medications, if you've got 3, if you got 2 or 3 different diabetes medication, that means it's still not under control. I'll sit with people and they say, oh yeah, it's under control. And then they bring out a bag of medication, like, no, that's not under control. So again, those are the things that underwriters look at, okay? I tell people it's kind of like good credit and bad credit, okay? So as if your health is good, you get usually preferred. If your health is not so good, but you're not bad, you know, you may get standard. And then if it's bad, then you are probably going to get rated, okay, or either decline. And I hate to see people get declined, but, you know, and so therefore you just want to, when you're talking to your insurance agent, just share with them, even if it doesn't go within that normal time, just still share with them if you've had something a long time ago. I'll have somebody say, oh, you know, I had cancer 20 years ago. Okay, well then that I don't have to worry about, you know. But if he had said, okay, yeah, but Doretta, 8 years ago, I had a bypass surgery, because I know even though he may not be taking medication, he still has to go to see a cardiologist, you know, every year, or usually every other year, whenever they release you to less years. But again, you know, that's something that I should have known. So again, when you're talking to your agent, make sure you just share those things with them, because those are the things that underwriters are looking at. They also look at your lifestyle. If you are sedentary, if you are active. That's why one of our applications asks, do you have a dog? Do you have a pet? Because if you got a dog, you're walking your dog. Okay. So, and then they will ask for about extreme sports, you know, snowboarding, skydiving, hang glide, all those different things, you know. It's okay to do those things, but you do have to have a form that you know, write off on. And then also in terms of even being an aircraft, you know, if you fly an aircraft, a small aircraft, not a commercial, but a small, so you have your own plane. So again, you know, underwriters look for different things like that. So basically, you just want to be upfront with your agent and let them make that decision. Is that okay? Is this something that we need to share with the underwriter, or not. Again, here lately, I've been getting a lot of people that's taking pain medication, and they are chronic because they are using it they're getting it refilled over 6 times a year. And that's even with asthma medication or anything that you're taking, more than 6 times having to get refilled, that's considered a chronic condition. So you just want to make sure that you understand that. And then most applications do ask for height and weight, so you just want to keep that in mind. That's not a declination, but that means that you may pay a little bit more due to height, due to the height and weight. So those are things as well. So basically, you just want to make sure that you get with someone. I'd love to talk to you if you're here in the Valley. I also I write for California, Texas, Tennessee, but Arizona definitely. But I'd love to talk to you if you have more questions. But then also, if you have someone that you do work with, or someone who work with, my thing is just get insurance. Just get insurance. You don't have to get it from me. Just get it from somewhere. It's vital. It's vital that you have insurance. And remember, like I said, with how I wrote my book, I never thought when I bought those 2 critical illness policies that I would use them. I used to always joke and say, I have these policies, so I'll never need to use them. And lo and behold, I had to use them. And was I ever grateful? And then also, even with the kid's father passing, you don't want to, but, if you have that, that makes all the difference in the world. That keeps the wheels turning. It keeps, things going. Nothing has to stop. So again, take the time. This is Life Insurance Awareness Month. Take the time, get that done. Just get with an agent, and we thank you. And I think we are just about to where we're asking questions here. I think they said they'll ask questions in about 3:50, so in a few minutes. So are we about ready, Jennifer, or do you want to?
I'm ready. Can you hear me?
I can hear you.
Perfect. I think you will see me in just a moment. I don't have any questions up on the screen at this point, but I have a couple of questions. First of all, my name is Jennifer Camano. I'm the Planned Giving Director for Arizona Foundation for Women, and I work with Doretta on the Professional Advisors Committee. And Doretta, thank you so much for your talk today. I feel welcome. Like there's so much information. I took mad notes. I'm curious. I definitely want to ask you a couple questions about estate, including the charity. But before I get to that, because I'm a newbie at all of this, you mentioned a couple of different policies, but at the very least having life insurance. And the 3 different types of policies, index, universal versus term versus whole life, what are the costs of these policies? Like, first of all, how much is a good amount to get, which I know it varies entirely. Mm-hmm. Depends on what you make and what your household income is reliant upon. But are there general rules of thumb, like you want to leave enough to pay off the house or to pay off certain debt or to pay for your burial or whatever? And also, what are the differences in costs? So I would imagine index universal might be the most expensive kind. Is it like $50 a month? And again, I know that differs depending on if you get the policy when you're 60 versus whether you get it when you're 20. Mm-hmm. But if you could talk a little bit about the differences in cost and coverage.
Okay, so definitely with the cost, say, I'll give you an example, say a 20-year-old, well, maybe not 20, let's do a 25-year-old, excuse me, 100,000. Theirs would be $17 for a term policy for a 30-year term.
Is that per month?
Mm-hmm. That's per month. Yeah, 100,000. So for a 25-year-old, you're looking at about $17 a month. Now, for a whole life policy for a 25-year-old for 100,000, you're probably looking at 70. Okay, or maybe not even 70. Maybe I'll say 55. Maybe 55. Yeah. So, and then your universal life policy. It's funny you should think that would be the most expensive. It's not usually, unless we get to a certain age. Okay, once we get to a different corridor, yeah, then it does. Like when we start getting over 60, yeah, it does get. But if that's why I said that the best ages, you're looking at 30s and 40s to get these universal life policies, and then they're going to be cheaper than the whole life policy. And due to the reason that is because you have your cash value that you're drawing from. So therefore, that kind of lessens what you pay each month as a whole life. See, whole life, you don't have the cash value that is building like the universal life policy. So with the universal life policy, you share in it. So I can have a person who, I'll take myself, for example. I actually got another universal life policy after I had gone through all my chemo and surgeries. I needed to be 1 year cancer-free from everything. So I got it last year in July of 2019. So with that being said, I was able to get that policy. Now I'm rated a table B, but B is better than decline or not anything. Okay. That particular policy is going to be more expensive for somebody at 58, my age, as opposed to if they were 35. Okay, so if the 35-year-old person went to go get a universal life policy, then their policy may be, and again, this is 100,000. So we'll say for a jump from 25 to 35, but 35, because that's the great age. So 35, you're probably looking at about $70 a month for a policy like that. Okay, and that particular policy has the potential to bring your cash value, to make your cash value grow, So you can have a whole life policy at 35, and your whole life policy, instead of being $70, maybe $55, but you're not growing that much cash value. So it's really, like I said, the universal life, the universal index universal life policies, they're kind of a hybrid between the term policies and the whole life policies. And you can put more into those because they're built to take out. Whereas a whole life, a straight whole life, isn't really built to take out. You can take it out, but as I tell people, you do need to pay yourself back. It's a loan. But with the index universal life, how it's rated and how it's capped, then you can do more. You've got more bang for your buck with the index universal life policies. They both do the same thing. They both can hang on same amount of years. It's just that usually you can do a little bit more with the index universal life policies.
So it sounds like it really depends on where you're at in your life and what kind of help you have. Yeah.
Right.
So
and what your goal is.
Yeah.
Yeah, definitely what your goal is.
Right. Can you leave a policy to a charity? Can you talk a little bit about that? Is it does it automatically go into your into probate, or is it a pay on death? Can you talk about thinking about charities?
Yeah. The beauty about life insurance, you name your beneficiary, and that goes to that beneficiary. It does not have to be a part of a probate. It just goes straight to the beneficiary. So you can put your beneficiary on the beneficiary form, and it can say AFW, you get the tax ID number, and you can you can definitely make that contribution to them. And then, when you pass away, it goes to the organization.
You mentioned that critical care policies are sometimes a part of a life insurance policy. Is there any advantage to keeping them separate, or is it, I didn't really understand that piece of why they're included.
Yeah. Well, and years ago, we didn't have these policies. Well, first of all, we were not having so many people go into long-term care and need critical illness policies, and then see the need that, okay, we can mesh it. We can put one into a vibrant universal life policy. Okay, so you can also get a critical illness on the long-term care policy. I'm sorry, on the term policy. So just depend on what policy it is. It may have, one bell or whistle, but it don't usually have everything that the universal life policy can do. Because again, the universal life policy is special because your cash value is tied to so many of those pieces, the long-term care, the cash value. Say if I didn't, say for myself, I wasn't able to get long-term care on my insurance policy now because of what I've gone through. So therefore, I have more money that would be going into my cash value as opposed to a little bit of that going into the long-term care piece. Okay, so each rider, you pay for those riders. You do pay a little bit for those riders. So I don't have any riders, so all mine is going to the cash value. But because I'm rated, some of my cash value is going back to the company because I have a higher monthly premium because of my health. So yeah, like I said, the Index Universal Life policy has so many different little facets and we're just different little widgets and gadgets and all that stuff to make it run. And then, like I said, your straight whole life is just a straight whole life policy. Your term policy is just a straight term policy. But the Index Universal Life policy has been just a great tool. Again, I've set my kids and grandkids up. So just to make sure that
it's a flexible policy.
Mm-hmm. Yeah, it's a flexible policy. Yeah. So say I can pay in 5 years. Say I lose my job, I call up and they say, "Oh, well, Doretta, you can, you don't have to pay a note for 6 months, because you've got that much built up, or you don't have to pay, for 2 years." So it just depends on everybody's situation is different. When they came into the policy, how much they're paying, how much they're putting in, but it is a flexible premium as well.
Well, Doretta, I don't have any more questions here in the queue, but I have tons of personal questions, so I think I'll be calling you.
Definitely calling me.
I might be a little over 50. I have 2 kids. I don't know what I can afford, right? Because I'm a single mom.
But we can definitely look. Yeah,
are probably really common for women. But definitely, I'll be chatting with you more about all of these and the advantages and disadvantages to any of them.
Definitely.
I'm going to look one more time in my queue to see if we have any other questions. We don't, but thank you so much. It was an absolute pleasure to talk with you today and to hear everything you had to say. And if anything, it's just opened up more questions that I have. So
well, good.
Take care.
I'm always happy.
And you stay well. And for anybody else who's still on the call, we sure hope you take time to look at our other Ladies Leaving Legacies events, virtual events that we will have coming up over the course of the next 6 to 9 months. We also have other speakers doing talks on qualified charitable distributions, tax implications, end of year giving. But there's, with the Secure Act and the CARES Act this year, there are advantages and things you're going to want to know when you're thinking about your charitable giving. And as always, we do hope that you value women and want to consider making a gift to the Arizona Foundation for Women. And we can be found at www.azfw.org. Thanks, Doretta. Goodbye, everyone.